Hello and welcome again to BNE's weekly blog with me, Ben Aris, editor-in-chief of BNE, and as ever I'm joined by Liam Halligan, our editor-at-large, to talk about what's going on in the world today.
Ben,
So,
welcome back.
welcome back from holiday, Liam, yes. And we're like straight into the deep end, aren't we? The world seems to be in chaos. Particularly this weekend there's a G20 summit. World leaders are going to try and fix the economies of the world, which is slumming, as you know. However, I think this is it, that things have decayed or deteriorated rapidly in the last month or so. That here in Russia, the predictions for a slow recovery seem to have gone out the window on the back of incredible fluctuations on the oil market particularly, which of course affects us, but they're symptomatic of wider problems of uncertainty. And I'm getting to the point where I'm starting to ask, are we headed into yet another global crisis? You wrote a Telegraph column sort of along the same themes. Do you think it's really getting that bad?
Yeah, I do. The number that's really concerned me, it's been kind of lost amid lots of other economic news, particularly out of China. Concerns world trade, Ben. World trade, it traditionally has grown at twice the rate of global growth, if you like, this
Mm.
sort of hyper globalization process. Well, we had a report out just in the last few days that said world trade during the first 6 months of 2015 actually contracted,
Mm.
and contracted at its fastest pace since 2009. That's partly off the back of ongoing stagnation in Europe, the Eurozone crisis, a long way from over, of course. The ECB is just hosing it down with printed money for now. But also China. The Chinese stock market has been roaring for the last 18 months. We've had very steep falls over the last few weeks, with leading to provoking, if you like, the biggest one-day drops on the US Dow and the FTSE again since the
But this is the
financial
thing, Liam. I mean,
crisis. Even though the Chinese economy itself is probably still growing,
but
the
you
numbers.
you um, you, you highlight the thing. This is the thing. Haven't we actually had a crash? I mean, the Chinese stock market is tanked, and I saw reports from Goldman this morning saying that it's got further to go. I mean, isn't this a slow-moving train wreck?
Yeah, the Chinese economy, the Chinese stock market, which has very little impact on the overall Chinese economy. The ownership of it is pretty thin and pretty shallow. The property market, of course, has a much bigger
Yeah.
impact on Chinese domestic economic sentiment. But symbolically, it's important. But because it roared up so much, it remains well up on where it was. And if you take out the bombed out
Yeah.
banks, the valuations are still quite high. So it could fall further. You're right. What you've been hearing in the last few weeks are comparisons between the 1998 emerging markets crisis, where,
Mm.
of course, a butterfly flapped its wings in Thailand,
Right.
and then that spread across Russia to the Western world, with a lot of Western press coverage trying to say this is the emerging markets' fault. If only they could sort themselves out, our economies would be fine. But of course, the last big financial crisis, 2008, was a crisis made in the West.
Yes. Yes.
And probably emerging markets now, Ben would say, the reason we're having such problems is because you've been QEing so much, and there's so much speculation about you guys having to raise interest rates
Yeah.
that is having implications on us, and so we're now in proper full-blown currency
Because
wars.
it's not just. I'm just looking at the RTS. I mean, that's down end of trading yesterday to 805. 805. The RTS just celebrated its 25th birthday this week, and it was only in May
Is it
2008. It was at.
long?
Sorry.
Are we getting old?
But its high to May 2008 was 2,600. I mean, 800 is back to the levels it was at the end of the 90s. And in Turkey
It's
too,
a
we were just.
dollar index, of course. So
Yes, so that's effective.
it's a dollar index, so it's taking the full brunt of
But even
the.
if you can, and
Yeah,
Turkey
for
too,
sure.
Turkey's going into crucial elections. Erdogan has been, he arrested these vice journalists, and then there was such an outcry. I think they realised that they'd bitten off more than they chewed and released them yesterday. But the Turkish economy too is tanking, and ironically, that's one of the ones that should be doing well on the back of low oil prices, in so much as they've had this horrible current account deficit, which is caused by the price of oil. And so, even though oil has tanked and Turkey should win is actually going backwards. So I mean, this is my question: why it's a crisis? You know, it's infected all of the emerging markets, those who are commodity producers, but even those who are not, like Turkey. And I'm starting to, as you say, get sort of the feeling that it's 1997 all over again, and whether this is going to get worse.
It is 1997 in some senses, except that the emerging markets are in general in a far stronger position than in 1997. Today, they're generally a lot less indebted, both sovereign and private sector, than their Western counterparts.
Yes.
They have 3/4 of the world foreign currency reserves between them. They have been, since the financial crisis of 2008, unequivocally the engine of global economic growth. What Turkey is symbolic, though, as you say, we've got the G20 finance ministers meeting there this weekend, and yet the lira has gone from an average of about 2 to the dollar in 2013 to 3 now.
Well, trading yesterday just off a record low, is it?
And this is a lot of the problem. You've got big speculation in recent months, dampened down in the past few days, that the Fed's going to raise interest rates. That's leading to a switch of hot money, if you like, away from the emerging markets towards the West. That's tanking EM currencies. While that gives them some competitive uplift, it also leads to panic and talk of 1998, as you say. But all this just goes to show how many massive imbalances there are now in the world. We're getting back to a situation where bad news is good news, because bad news means the West is likely to go back to doing more. We've got now, just in the last few days, a lot of speculation, some of us have been saying it for months, that the Fed won't raise rates anytime soon because of more financial volatility. The likes of Larry Summers, former US Treasury Secretary, being wheeled out to say, oh, maybe we should have some more QE. Lots and lots of imbalances, lots and lots of bloated financial asset prices, not only in the West, but the emerging markets too. Very difficult to invest.
How important is this interest rate thing, in so much as IMF Christine Lagarde came out a couple of days ago ahead of this meeting specifically to say, please do not raise interest rates soon. And I think that was aimed specifically at this meeting coming up. And moreover, if you remember in 2008 when this whole fracas started, I remember it was quite clearly when the US interest rates went to 5.25. There was a hike, and then almost immediately afterwards there was this massive collapse, because you'd reached the level where investors thought, why am I taking risks in emerging markets, because there's been free money before, I couldn't make returns, I had to go there because it's the only place I can make returns, but now I can make returns in the States safely, and all the money left, and then it sort of started this domino effect and the whole thing collapsed and got worse. And we're kind of in the same position now, except, as you say, interest rates are back at zero, which pre-2008 fueled a massive boom in emerging markets. But now the interest rates are back at zero, and yet they're talking about raising the rates, so it's going to be compounded. It's going to be even worse, isn't it? I mean, if the Fed does raise rates in now, not September, as they're saying, December or whenever, isn't that going to just undo, it's going to crush these emerging markets even more?
What we're talking about here, of course, are roughly stock and bond markets rather than real underlying economies. Right. So, of course, there are feedback effects. The big story is that the world hasn't properly recovered since the Lehman moment. America hasn't staged a convincing economic recovery. The Eurozone, of course, has deteriorated massively. It's only really been the emerging markets that have been growing, and even they've been only in second and third gear, because the Western world itself hasn't been properly growing. And despite massive monetary and fiscal stimulus, we still haven't had that proper liftoff.
Yeah.
What the Fed's trying to do now, and has been for a number of years, and it's tried to raise interest rates several times in the last couple of years, and it's been warned off by financial markets with more volatility, so then it's lost its nerve. And the IMF has now just sanctioned another delay in interest rates after Janet Yellen, for the second time in what's only been a short tenure so far, has basically said to the markets, hey, we're about to raise rates.
Yeah.
Financial markets haven't allowed the Fed to raise rates. And the reason is, Ben, because for all the talk of calm and it's all fine, no one knows what's going to happen when the Fed, the Bank of England, and all the rest of them move towards a more normal monetary position. Financial assets, particularly in the West, have been on QE steroids now for many, many years, and no one knows what the patient's going to do when there's any sign of genuine cold turkey.
And
A lot,
that's
a lot of people would say the only reason asset markets in the West are staying relatively buoyant, if you like, is because we've had so much QE and there's the prospect of more QE to come. The prospect of more QE has not been taken away.
Yeah, I mean, isn't that the elephant in the room? I mean, all the talk, the press has been talking about the collapse of commodity economies such as Russia and blah, 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 and China slow down. But if you look at things like debt, Russia's debt is now fallen to 5% of GDP, and the capital flight, the bulk of that is to go to pay off loans. And so corporates had to pay off something like $100 billion last year. This year, they were going to pay off 60. The central bank just came out and said it actually is 30. And as soon as next year, it could be that Russian corporate debt, as well as the sovereign debt, is actually largely paid off. Whereas if you look at the West, everybody's at 90% GDP debt. You know, some countries like Italy, 130%. And nobody's talking about that.
Lots of debt stashed elsewhere.
And no one's talking about that.
It's not so much the elephant in the room, Ben. It's a sort of very, very large prehistoric elephant that's about to crush the entire house.
Mammoth, yeah. The Russians are about to clone mammoths, actually.
In my view. Yes, of course, thin, immature, nascent asset markets, stock and bond markets in the emerging markets have themselves been on a bit of a tear over recent years, are in some cases themselves overvalued. They will suffer massively as there are signs periodically of rising interest rates in the West, just because the hot money will whoosh away. The underlying economies, though, while they've been dented, of course, and history and growth doesn't happen in a straight line, are fundamentally much stronger today and far more likely to grow a reasonable clip over the next 5 years in the emerging markets. No question at all.
Yep.
And it strikes me. It strikes me that there is now a sort of blame game going on about there is going to be a crash. Whose crash is it going to be? Is it going to be a Western crash like in 2008, or is it going to be an emerging markets crash like in 1998?
Yeah.
You see these themes emerging in the emerging market press on the one hand versus the Western press on the other. My own personal take is that this will be a crisis that's been sparked in the West, not least by rampant use of monetary expansion since the financial crisis. But the emerging markets themselves have done not as nearly as much as they should have done to get their houses in order in terms of reform and deepening their own capital markets and getting more long-term domestic investment in there in order to prepare for this moment. They're a lot more prepared than they were for a crash, the emerging markets, in terms of their general macro, but not in terms of the setup of their financial markets in mind.
All right, on that note, we'll leave it there. Before I go, though, I'd remind you, Liam, we've got a panel discussion coming up, haven't we, in London, covering Turkey related to the elections that are going on there.
Okay, we've been running these BNE events in London, of course. In fact, in October, Ben, Tuesday, the 27th of October, we've got our latest panel discussion on Poland.
Right.
Poland, of course, has got parliamentary elections, vital parliamentary elections, on the 24th of October, Sunday the 24th of October. That event is at Cass Business School. You can register for it on the BNE website. It's free. And then on the 24th of October, again in London, we're doing an evening debate on Turkey. And we've scheduled that because of the snap election, of course, that's been called in Turkey this autumn.
Good stuff. We'll be there if you want to come and see us. We look forward to it. All the best. Talk to you then.
Cheers, Ben.
Ciao.